Okay, everybody, how are you? So we're going to start chapter 9 today. And here you can actually see me today. I think you'll be able to see me, at least that I can see myself. So anyway, so we're going to start chapter 9. And we're talking about long-term liabilities. And we'll just go through a brief discussion. Notice where liabilities are on the balance sheet, right? Assets, liabilities, stockholders' equity. Liabilities can be broken down into two categories, current and long-term. We're talking about long-term. They start out with a discussion of notes payable, right? I'm not going to get into that with you. Leases. Sometimes companies, if they don't want to tie up a lot of their cash in purchasing assets, they will lease them. Right? We're not really going to get into the leases here, but this is where we're going to start. Bonds. A formal debt instrument issued by a company to borrow money, right? This is page 447 in your book. Now, how is bonds, it's a way of borrowing money. How is it different than borrowing money from the bank? Typically, you go to the bank, you say you want to borrow $10,000. They give you the $10,000. They say, okay, this is when you have to pay it back. This is what the interest rate is going to be. And these are all the things that are going to happen to you if you don't pay it back on time. How is a bond different than that? Bond is a security. A bond is something that is sold to the public. Just like stock can be sold to the public, bonds can also be sold to the public. The term that they use is underwritten. The three largest bond underwriters, JP Morgan, Citigroup, Bank of America. Now here they're going to go through a lot of terminology. You can read this and you can, look at the definitions of things. But just really quickly, bonds can be secured or unsecured. Secured means that there's collateral. Something was pledged as collateral. Unsecured, there was no collateral. Term, all the bonds mature at once. Serial, they mature in installments. Callable, the company has the right to buy the bond back from you prior to its maturity. And convertible, sometimes bonds are sold that can be converted into shares of common stock. Right, so they go through those explanations. Now here, this is typically what a bond looks like. They're giving you a timeline. Face amount, that's the amount that's due at maturity. In this case, it was $100,000. In addition to paying back the $100,000 at maturity, the company is required to make periodic payments of interest. Now notice, these bonds are 7% bonds. The interest rate is 7%. So 100,000 times 7% is $7,000 a year, or $3,500 every 6 months. That's typically how bonds are sold. They pay interest every 6 months. Okay, now this next topic, we're going to start out simple, and then it gets kind of difficult. See, one of the problems with bonds, one of the things that makes it different than borrowing money from the bank. Typically, if you go to the bank, you borrow $100,000, you have to pay back $100,000. You take in 100,000, you pay back 100,000. But with bonds, that almost never happens. With bonds, you could take in more than 100,000 and pay back 100,000, or take in less than 100,000 but have to pay back 100,000. Don't worry now about how can that happen, right? Just know that it does. So here's a simple example of a company sold bonds. They use the word issue, right? It means sold, for $100,000. This is a $100,000 bond, face amount, 7%, due in 10 years, interest payable semi-annually, June 30th, December 31st. So what entry gets made the day the bonds are first sold? Debit cash, credit bonds payable, right? Remember how to do journal entries? Debit cash, credit bonds payable. Now, every 6 months, they have to pay interest. Debit interest expense, credit cash. And remember how we calculated the interest in this case. The 3,500 is 100,000 times 7% times 1/2. Whenever you see an interest rate, it is an annual rate. So we're multiplying by 1/2 because we only want to know what's the interest for 6 months. Now pay attention to that credit to cash, right? Because we're going to see that again. Okay, now, sometimes bonds can be sold for below face value. So in this particular case, the bonds were sold for $93,205, but we have to pay back $100,000. These bonds are sold at less than face amount. The term for that is discount. These are bonds that were sold at a discount. Now, what does discount represent? It really represents extra interest expense. Now, we can't record the interest expense all at one time. We have to take it and we have to spread it out over the lifespan of the bonds. Remember, these bonds mature in 10 years. So we're going to take the $6,795 and we're somehow going to add this to interest expense every year. Remember, interest expense was $3,500? Well, when bonds are sold at a discount, the interest expense is going to be more than $3,500. Right? We'll go through the calculation, but just so you understand. Now, why can bonds be sold at a discount? Why would someone be willing to pay less than face value for the bond? And it has to do with interest rates. Bonds trade in the marketplace based on interest rates. So these are bonds that pay 7% interest. If the day I took them to the marketplace to sell them, the rate of interest in the marketplace that day was 8%, because interest rates change, right? They're not the same all the time. If the market rate of interest was 8%, that means I could get 8% by buying somebody else's bond. Why would I pay full price for your bond when you're only paying 7%? So I'm going to pay you less. Now, we'll see when we get to the end of the chapter. For some reason, they show you this at the end of the chapter. I'll explain to you how you calculate that number. But for now, just understand, right, that they're telling you that they sold bonds. They received $93,205 that had a face value of $100,000. So you've got your debit to cash for what you received. You've got your credit to bonds payable for face value. And then you've got a debit to this account called discount on bonds payable. It's a contra account. Remember we learned about contra accounts last semester? Accumulated depreciation was a contra asset account. The allowance for doubtful accounts was a contra asset account. Well, this is an example of a contra liability account. On the balance sheet, this is how we would show it. We would show bonds payable at the face amount minus the discount gives you carrying value, right? Carrying value. Okay, so now we're going to calculate interest expense. Interest expense is calculated based on the carrying value. So when the bonds were sold for face amount also happened to be the carrying value, right? That's how we came up with that $3,500. But now interest expense is going to be based off of this number, carrying value. So if I multiply 93,205 times the market rate of interest times 1/2, there's the interest expense. So what journal entry would I make? I would debit interest expense. I just calculated it, right? Credit cash, that's the same. Credit discount. Now, every time I make this interest calculation, the carrying value changes. So I'm going to take this $228 and I'm going to add it to the carrying value. Remember the carrying value was 93,205? I'm going to add that. So that'll give me a new carrying value. See what they did? 93,205 plus 228. Multiply that number times 8% times 1/2. 3737 is the debit to interest expense, right? This is the second interest payment. This is the payment that was made on December 31st, 2021. This was the payment that was made on June 30th, 2021. So debit interest expense for that new amount, 3737, credit cash for the 3,500, and now your credit to discount is 237. So interest expense is going to be different every period. Every 6 months when I pay interest expense is going to be different. But notice what happened from the first payment to the second. The interest expense, right, was $37.28. Now it's $37.27. Why did it increase? Why is it higher? Because the carrying value is increasing. This is what's known as the effective interest method. There are two methods of doing this. One's called the straight line method. Your book does not show you the straight line method. This is the only one we have to work with. This is called the effective interest method. And under the effective interest method, when bonds are sold at a discount, interest expense gradually increases because the carrying value increases. Now, they like us to put it in this form, a table, where we show the date, the dates the bonds were sold, and then each succeeding interest payment. Notice they skipped here, right? Because these are 10-year bonds, there would be 20 interest payments. How much is the cash paid? The cash paid is based on the rate of interest that's on the bond. These were 7% bonds, $100,000 times 1/2, $3,500. Remember how interest expense is calculated. It's the carrying value times the market rate. Market rate. Carrying value to start out with, 93,205 times 8% times 1/2 was this 37.28. The difference between interest expense and cash paid was $228. When we made the journal entry, that was what we credited to that discount on bonds payable account. Here, what they're doing, they're taking it and they're adding it to the prior carrying value. So you got a new carrying value now is 93,433 times 8% times 1/2 is the 3737. What's the difference between the two columns? 237. Add the 237, now you get 93,670. Now notice what happens at the end. What's the carrying value at the end? It's the face amount. This is the amount you're going to have to pay back. Because remember how a bond works. You're borrowing money today, and 10 years from now, you're paying it back. Over the 10 years, you're paying interest. So you took in 93,205 on January 1st, 2021. And on December 31st, 2030, you're paying back $100,000. That's almost $7,000 more, right? $7,000 more. That $7,000 represents extra interest expense. And if you were to total up all the interest expense and compare it to the cash paid, the difference will be what that discount originally was, which was around $7,000. Now, just like you have bonds that can be sold at a discount, you can have bonds that are sold at a premium. What's a premium? The bonds are sold for more than face value, face amount. So here, these 7% bonds were sold at a time when interest rates were only 6% in the market. So if you're paying 7 when everybody else is paying 6, you would be willing to get more for those bonds. And again, we'll get to the end of the chapter and we'll explain how these numbers are calculated. So here we debit cash for what we receive, 107,439. Credit bonds payable for 100,000, face amount. Credit premium this time, premium, not discount, premium, 74.39. So while discount represents additional interest expense, premium represents a reduction in interest expense. Reduction. So we're taking in 107,439. We're paying back $100,000. This 74.39 is going to be spread out over the 10 years, and it's going to be used to reduce interest expense. So here they walk you through the entries. Now notice the debit to interest expense is less than the credit to cash. Remember with discount, the debit to interest expense was more than the credit to cash. So again, like I said, discount represents additional interest expense. Premium represents a reduction in interest expense. It's based on face amount, like before, 107,439 times the market rate, 6% times 1/2, 32.23. Credit cash, 3,500. The difference, 277. 277. Okay, now notice what happens. With premium, we added it to the carrying value. With discount, we're going to subtract it from the carrying value. So here we have a debit to interest expense. This is the next payment, the December 31st payment. We're going to take the original carrying value and subtract, right? Subtract that 277, right? That's this 277. Multiply that times the market rate times 1/2, 32.15. Credit cash, 3,500. Debit premium, 285. Notice what happens with premium. Interest expense goes down a little bit. See it? From 32.23 to 32.15. Why? Because the carrying value is decreasing a little bit. So here's what it would look like in a table. And when we do homework, we're going to do this table, right? You're going to see what it looks like. So you got your column for date, just like before. You got your column for cash paid, just like before. Face amount times stated rate. That's 7%, right? Interest expense based on market rate. The market rate was 6%. Carrying value times 6% times 1/2. Right, so that gave us 3223. The difference between the two columns is 277, but now we're going to subtract the 277. We wind up at 107,162. 107,162 times 6% times 1/2, 3215. The difference, 285. Take that 285 and subtract 106,877. Notice the carrying value decreases over time, right? And we still wind up, though, we wind up with the face amount, right? So we have to wind up with that $100,000, whether it's discount or premium. The difference, though, is what? With the discount, we start out below face amount and gradually increase the carrying value. With premium, we start out above face amount and we gradually decrease till we get down to face amount. Okay. So I think we can look at some homework now. So, problem 9-4A. Problem 9-4A, which is on page 481. Page 481. And I'll read it to you, right? You can have your book out in front of you. On January 1st, 2021, Twister Enterprises, a manufacturer of variety transportable spin rides, issues $600,000 of 8% bonds due in 20 years with interest payable semi-annually on June 30th and December 31st each year. So it's almost the same example that we saw in the textbook when we looked at those pages. So these are $600,000 face value, 8% bonds due in 20 years. So notice they give you three different scenarios. If you look at the required, three different scenarios. The first one says, what would we do if the market rate of interest was 8%? Well, if the bonds pay 8% and the market rate is 8%, that means those bonds sold at face amount. That's the easiest of the cases. That's the easiest one to do. No discount, no premium. In the second case, the market rate is 9%. We're paying 8%, so we're going to get less than face amount. So notice we're going to get in part 2, we're going to get $544,795. And then in part 3, the market rate of interest is 7%. We're paying 8%, the market's paying 7%. We'll get more than 600,000. We'll get 664,065. So they want the entry that's made to purchase the bonds, sell them, I'm sorry, not purchase, sell. And then, right, so let's make the journal entries. So this is problem 9-4A, and this was on page 481, and I'm going to put these notes on Blackboard someplace, so you'll have them to look at. But I like to do the problem in front of you so you see how it's done. See, a lot of times when you're doing things on Connect, they just give you boxes to fill in, and they really don't show you how to do the problem, right? You have no place to really show your work. But that's why I like doing this. Now remember, when you do the problems on Connect, they're going to be the same problems, but your numbers are going to be different. The numbers I'm using come straight out of the textbook. So we got a column here for date. Let's call this one account titles, right? We're making account titles and explanation. We got a column for debit. And we got a column for credit, right? Okay. So the bonds were sold January 1st, 2021. Right? And under number one, the bonds were sold for $600,000. So debit bonds payable and credit cash. Excuse me, debit cash and credit bonds payable. I'm sorry. Debit cash and credit bonds payable. Now we're going to make the first interest payment. We're going to debit interest expense, right? And we're going to credit cash. All right, now let's put the amount down here. 600,000 heck. 600,000 times 0.08, right? That's equal to $4,800 times 1/2 equals $2,400. So we're going to debit interest expense and credit cash $2,400. And on December 31st, we will do the same exact thing, right? We'll debit interest expense and credit cash $2,400. Right? I'm just going to say here, number one, bonds issued at face amount, right? And here, bonds issued at discount. So on January 1st, 2021, we're going to debit cash. Now remember what they told us. The bonds were issued at $544,795. We're going to credit bonds payable $600,000. That means we need another debit. For debits to equal credits, we need another debit. And that debit was called discount on bonds payable. Right? And what's the difference then between 600,000 and 544,795? It's about what? It's about $55,000, right? It's 55,205 to be exact. Okay. So we sold these bonds, we took in 544, but 20 years from now, we're going to pay back 600,000. We, in effect, will be paying an additional $55,000 in interest. But we're going to spread that out over the 20-year period. So 6, 30, 2021. We are going to debit interest expense. Now, how are we going to calculate interest expense? We're going to take the carrying value times the market rate. What was the market rate? 9%. All right, what does that come out to? I got to get my nifty calculator out. 544,795 times 0.09 is 49,031. Let's call it 032, right? We'll round up times 1/2. That can't be right. That can't be right. Let's take another look at that. Oh, yes, it is. Okay, I made a mistake up here, class. I am very sorry. This number here, right? This is what happens when you do things like this. This number here is 48,000. This number is 24,000, right? 24,000. I apologize, right? 24,000. So what's this number going to be? 49,032 times 1/2 is 24,516. 24,516. Now the credit to cash is the same as it was in the first example, right? Because the credit to cash is based on the what's called the stated rate or the face rate, the rate that's on the bond. So now we need, to make the entry balance, we need a credit of 516. What account should we credit for that? Discount on bonds payable. Okay. And then on 12/31, we're going to make a similar entry. We're going to debit interest expense. Okay. But now we have to calculate the carrying value. And the carrying value is the 544,795 plus the 516. So 544,795 plus 516 is 545,311. That's the new carrying value times 0.09 times 1/2. Which comes out to 24,539 rounded. You still have to credit cash for that same $24,000 from before. And now we need 539 to balance the entry. That's discount on bonds payable. Okay, so that's bonds sold at a discount. Part 3. Part 3 is similar to Part 2, except that the bonds are being sold at a premium. So 1/1/21 You've got a debit to cash. Now look at the number that they tell you. 664,065. 664,065. Credit bonds payable. 600. Right, and this time premium on bonds payable. Right, and what's the difference? 664,065 minus 600,000 is 64,065. So we sold the bonds for 664, and 20 years from now we got to pay back 600. That extra $64,000 is going to be used to reduce interest expense. Okay. 6/30/21. Debit interest expense, right? Carrying value, 664,065 times market rate. Market rate, 7%, 0.07 times 1/2. Debit interest expense. $23,242. Now, we're still going to credit cash, $24,000, just like we did in each case, first case, second case, now third case, which means what? What number do we need to put in here so that the entry balances? It's what? It's about less than $800, right? It's $758. And that's going to be premium on bonds payable. Okay, and then on 12/31, we're going to debit interest expense. And we're going to calculate the new carrying value, 664,065 minus this time, right? Minus 758. $664,065 minus 758, 663,307 times the market rate, 0.07 times 1/2. Remember, 1/2 because it's half a year. And that number will come out to be 23,216. We still got the credit to cash, $24,000. So now what's the difference? We need a number to balance the entry. Again, it's around $800. The difference between 24,000 and 23,216 is 784. And that's going to be premium on bonds payable. So that takes care of that homework problem, 9-4A. Now you also have to do 9-6A and 9-7A. And if you can do this one, you can do those, right? Because they're pretty much the same. I am not going to go over those right now, but they want you to do a table rather than just calculate the carrying value like I did here in the entry. They want you to do the actual table, just like the textbook showed you, right? just like the textbook showed you. So do the same thing, use the same column headings, and you should be okay. So that's all I wanted to cover with you in this video. There's another topic here that I'll get to next, but that'll be a separate video. There's going to be 2 more videos in this chapter. This was the main one, I believe, but then you have another one on what happens if you pay off the bonds prior to maturity. That's called retiring bonds. So we have a problem to do for that. And then we have another problem where I'm going to show you how they calculate these numbers. See how they got this 93,205? See how they got this 104,739? In the homework, see we got these numbers, 544, 795, 664, 065. I'm going to show you how you calculate those numbers. So that's all I wanted to do with you in this video. I will post these on Blackboard someplace. I'll send an email showing you where they are. And I'll see you in the next video.